Welcome, Anish. Can you tell our viewers a little about your funds?
Sure. Thanks for having me, Mark. I manage two areas of funds at TD Asset Management. One of the areas is Canadian value equities, and that's one part of what I do. And the other area that I manage at TD Asset Management are target return funds, which are essentially asset allocation products where we look to achieving a certain target over a 5-year market cycle.
How would you describe your investment philosophy?
When you look at it, and I'll focus a little bit here on the value side, we're long-term, patient value investors. What we're looking for in companies are strong free cash flows, strong returns on capital, solid balance sheets, good management teams. And what we want is that entire package, so quality business franchise at an attractive price. And so that's essentially what we're looking for. And we tend to have longer holding periods in the 3 to 5 year range. And though we look all across the capital structure, small cap, mid cap, as well as large cap for ideas, generally we're in the large cap space.
It must be quite a challenging task to manage such a large sum of money. How do you keep your eye on the ball while dealing with the inherent volatility and constantly shifting investment choices?
Well, when you look at it, and our philosophy on the value investing side is long-term. We don't have a trading-intensive strategy, so we're patient long-term investors when we're looking at our value equities. In terms of the changing investment landscape, one of the great things of being part of TD Asset Management and being part of the Wealth Asset Allocation Committee, for example, I'm able to lever off the different expertise that we have across the firm. So if I wanted to talk to somebody about U.S. equities or U.S. fixed income, I'm very able to do that. So being part of a broader organization really helps manage the changing investment choices that we have.
What is your outlook for North American stock markets in the next 12 months?
Well, we're certainly constructive on the markets, Mark. When you look at what central banks have done all over the world, they're essentially being very accommodative, regardless of where you look around the world, whether it's Canada, U.S., Europe. So that's a very positive backdrop for economic growth. And also when you look at different areas around the world, different countries, different regions, they're also doing reasonably well. So Europe seems to be making it through just on a muddle-through basis. The U.S., they certainly have some issues around government, but when you look at their fundamental economy, rebound in house sales, rebound in auto sales, so they're doing quite well, coming in around 2% GDP growth. And when you look at emerging markets, they used to be growing at double digits, now they're mid-single digits. But when you look all around the world, we're still moving ahead, but at a slower pace than we did a number of years ago.
One of the key concerns relating to the Canadian economy is the housing sector, which many investors believe to be overvalued. Do you think that we could see a U.S.-style crash here? And what would be the implications for investors?
Mark, I think when you look at how the Canadian housing market, the Canadian financial system are structured, and you compare them to the U.S., there are certain fundamental differences. First of all, in the U.S., their system was more and more originate to sell, so they would originate a mortgage, and the person or the company that originated the mortgage wouldn't own the mortgage until maturity. It would be sold in the marketplace. Whereas in the Canadian banking system, one of the Canadian banks or other Canadian lenders actually originates the mortgage, so they'll do all the credit work, and they have to deal with any issues at the end of the day because it stays on their balance sheet. So that's one big difference, the fact that mortgages stay on the balance sheet here in Canada versus the U.S. The other thing that has happened in Canada is that the Canadian government has been very proactive at slowing down the Canadian housing market. For example, we used to have 40-year amortization mortgages, and we don't have those anymore. So I would say between the banking sector differences and the Canadian housing as it relates to the Canadian government, those are just very big differences between Canada and the U.S.
So do you think that Canadian large caps are currently undervalued, especially in relation to U.S. large caps?
Well, I think there's certain areas where there's some pockets of value, but when you look at U.S. large caps, one of the distinctions between the U.S. market and the Canadian market is the fact that the U.S. market just has more breadth and depth in certain sectors, and I would say in areas like consumer staples and technology. But when you look at Canada, we're more focused in terms of sectors on financials, energy, and materials, so financials as well as the natural resource sector. And what we find in terms of attractive areas for us would be the Canadian banking landscape, where you can get, as a sector, Canadian banks at 10.5 times forward earnings, whereas historically they trade at 12 times forward earnings and a dividend yield of around 4%. So attractive relative to history, as well as an attractive dividend yield. And when you look at large cap energy producers in Canada, they trade around 5 times cash flow, whereas historically they've traded around 6 times cash flow. So Canadian financials in banking and Canadian energy are certainly areas we find attractive today.
So what sectors do you currently like within Canadian equity markets, and what sectors do you think might outperform in the next 2 to 3 years?
Well, I think when you're looking at trends, one of the trends that you have to be mindful of over the next few years is just rising interest rates. And the issue around rising interest rates is certainly interest rates have risen. If you look at the U.S. 10-year Treasury, it used to be 1.5%. Today it's over 2.5%. But what is the implication that has on equities and different sectors within the equity space? So if you're looking at generally some of the equities that have done well historically as rates have come down, such as pipelines and utilities, they may not be the leaders in an area in terms of stock market performance when rates go back up. So you just have to be mindful that this trend towards rising rates may just have different implications as compared to the past.
Since a big part of your portfolio is yield-oriented, do you have a big exposure to REITs? What is your view on this investment class?
We do have a preference for dividend-paying or yield equities on the value side. We do not have a large exposure to REITs. Generally, we found that they've traded somewhat expensive to historical valuation levels, and we found, in terms of certainly the financials area, just more attractive valuations in the Canadian banks.
In September 2013, the U.S. Central Bank surprised the markets by staying put on its monthly bond purchase program and expansionary monetary policies. Most investors believe that interest rates are going to inch higher eventually. How are you dealing with the rising interest rate environment and adjusting to it?
Certainly, Mark, and I'm going to answer that from two perspectives. From the point of view of an equity investor, and since I also manage target returns, I'll talk a little bit from the debt side. But as equity investors, we want to make sure that what is the impact of rising rates on the companies we hold. So what would be the impact of rising rates on their earnings, on their cash flow, and we also want to understand what a rising interest rate environment, what impact that would have on the valuation of those equities. So how it's valued, as well as the impact on earnings. So that's on the equity side. When you look at the fixed income side, let's say, for example, you wanted to invest in a 10-year type of fixed income instrument. I mean, interest rates can change dramatically over a 10-year period. So what we've done in target returns is we've kept the duration short. So we're investing for shorter periods. So if you're looking at a 2 to 3 year type horizon in fixed income, less things can happen, and you can adjust things at the end of that period or during that period, as opposed to investing for a much longer term.
Right. So we understand that you tend to deal more in the large cap space. Are there some small and mid cap companies that you might follow?
We tend to look all across the market cap spectrum on the value side, but for us in small cap and mid cap, we tend to find names more in the aerospace or the industrials side of things. And recently we've been finding some names similar to large cap names in energy. There's also some mid cap names in energy that are attractive. So it's generally, where can we find value? Generally, we've been able to find it on the large cap side. Sometimes we find it in small and mid cap, and lately we've been finding it in mid cap energy as well.
So I have to ask if you could share a few of the names from your top 10 list or your top 10 holdings in Canadian equity funds.
Sure, I'll highlight two names and in the sectors that we've already talked about. One of them, this is in the context of the Canadian value fund that I run at TD, and one of the names would be Suncor. So when you look at an energy company, you generally have two risks. One is exploration risk, working to find the oil. In the case of Suncor, it's in the ground, so you don't have that particular issue. And you also don't have to deal with political risks as much with Suncor, in the sense that you're not dealing with politically risky jurisdictions. Suncor's oil is in Alberta, so it's in Canada. So the two big risks that you generally have, exploration and political risks, are very much less so in Suncor. When you look at Suncor, one of the questions that Canadian investors have been asking themselves is, generally Canadian energy companies have really been focused on production growth. Now they've been able to strike a better balance between shareholder return as well as production growth. So when you look at Suncor, they should be able to grow their production by 10% next year. when you look at where they trade at a 5% discount to NAV. They've got a dividend of just over 2%. They've got a 4% stock buyback program in place. So all sorts of great valuation metrics around Suncor in terms of their level of attraction to us. And then the next name I'd like to highlight is in the banking sector, and that's the Bank of Nova Scotia. What we find interesting about that is the fact that 25% of their earnings come from their international segment. And for a while, for the last number of years, the emerging markets were certainly the place to be. And in Scotiabank, you had some of that exposure.
Great. Thank you very much, Anish. We know you're a very busy man, and we very much appreciate you taking the time for the interview.
Great. Thank you very much for having me, Mark.
You can get more expert interviews on the experts page at smallcappower.com. And don't forget to sign up to receive the weekly Ubica Gold 50 report featuring our list of the top 20 gold prospects. smallcappower.com. Investment ideas and research.